What's up, guys? This is Shane Schofield for the market update. Today's date is the 2nd of the 7th, 2017. And here's a quick disclaimer for you guys to read. Just pause it and have a quick read through. Just make sure you always keep your risk limited. A bit about myself. I'm Shane Schofield. I'm the founder of ScofieldTrading. I trade US equities. I'm a technical trend trader. I like to trade trends. Also a public speaker. I speak for XTB with an event coming up next month. Manage a private fund. Start off spread betting from home. There's an ebook available on our website, ScofieldTrading.com, where it shows how I turned a 4-figure account into 6 figures in the space of 18 months.
Hi guys, my name is Ty Vinnick. I am the co-founder and portfolio manager of the Ace of Swords hedge fund located in California. I specialize in trading options. I trade futures or market indices on different commodities. I'm more experienced in professional money-making strategies such as option spreads, ratio spreads, calendar spreads, things of that sort. I'm a market timer, so I try to time tops and bottoms and opportunities in the market more than I am a trend trader. And I'm also a technical and statistical trader.
Okay, so the first thing that I want to go over is the Dow Jones Industrial Average. Looking at it recently, we had a volatile day on Thursday where the Dow was very, very, very volatile. And me and Ty were speaking about it that day, and we said to each other the next day is going to be interesting to see how it plays out. And what played out the following days this week, that we get this inverted hammer bar, which I believe is more selling pressure. And looking at the market overall, if I go to the S&P 500, so looking at the S&P 500, it does look weaker. As you can see, price action's consolidating, and we're actually, the selling pressure's coming in more than the buying pressure, I feel like. The perfect example of this, I feel, is the NASDAQ 100, which is the weakest in my opinion. And the reason is...
It broke that trend line we talked about.
Yeah, it did. So here's the trend line, which it actually eventually broke, and then it's tried to push up to make new highs, and it's failed that, and it's actually came down and made a new lower low. So this is dangerous to me, and this is a signal that the NASDAQ's looking a lot weaker. So basically the way that I see this, and you can tell me if you agree with this, Ty, is that buying the dips has always been working. So every time the market goes down, the dip gets bought. The market goes down, the dip gets bought. And we're getting the same again here. The market comes down, the dip gets bought, but this time, as the dip has been bought, the market's tried to go up, and it's not going up to new highs. So as it comes back down to where the dip buyers got in, all these dip buyers here need to make a decision. So they're back at break even. They need to decide whether they're going to start coming out of their positions and start pushing this market lower. This market will have a lot of selling pressure and start coming lower, or maybe add to their positions or limit their positions. Basically, they need to make a decision, and I think this could potentially be the reason why the market could potentially start trending down lower. How do you feel about that?
That's exactly the psychology behind the head and shoulders pattern. Every dip gets bought, and then the last one fails, making that right shoulder. And then when it breaks through the neckline, everybody that bought the last dip is underwater, and that can potentially push the market significantly lower. And also you have short sellers that can now join in, seeing that the market's becoming weaker, and push it even lower. So you'd reckon it can go easily to that 200-day line.
Yeah. Do you think when it does happen, do you think it's going to happen fast, though?
Usually declines happen much faster and much more aggressively than people anticipate, and the main reason for that is that fear is stronger than greed. When you're looking at your account and you're like, oh, I'm up $200, I'm up $500, all is well, you're not too keen or too quick to take your profits. But when you look at your account, it's like, oh my God, I'm down $1,000. It freaks you out. So when that happens, that's why declines are usually so much faster, because fear is such a stronger emotion than greed.
Yeah, definitely. The only thing though with the Dow Jones is that, you know me, I like hammer bars as a sign of buying pressure, and we do have that on the weekly chart. Same again, we have the hammer bar here, and we still have a lot of people who are potentially short the market. So I think maybe this big sell-off could potentially happen, but I just don't know when it's going to happen. So it could take a while for it to actually kick off, because we could potentially consolidate for a little while, and then one day it's just going to be big sell-offs, possibly. So I think trading this would be better to go to the VIX. And looking at the VIX, we've got this trend line, which has been perfect. And this is why on this day, on this Thursday, I was watching this carefully, and I just had an opinion that it was just going to bounce off this trend line. And I think potentially if this market does correct, and it corrects fast, I think the best trade to place is the VIX, and have October calls at around $15, which go a $15 call, which goes for about $2. And I think if the market does end up having this big correction, we could see the Dow, the 200 moving average, and I think the VIX could push up to potentially $30, and it could push up very quickly.
Well, usually in a pattern like this that gets smaller and smaller, when it breaks out, the target will be the width of the entire pattern. So you can measure the move from 26 to 10 and extrapolate it to the exit point. So yeah, that's between 26 and 30. I totally agree with you. And I think it's going to happen very fast.
Yeah, so instead of trying to pick the market, overall market, like the Dow, trying to short that, I feel like we don't know when this collapse could sort of happen, even if it does happen. But I think the best way and the safest way and the smart way to trade it is to trade the VIX. Just have calls for October, which lasts for the 6 weakest months of the year for the markets, and then just wait. Just hold it and wait. And in the meantime, maybe short weak stocks with very, very low risk, because like you said, when the markets fall, they tend to fall really badly, and you know, a small trade could end up being, you know, quite large returns. So
I want to. It's true. Also, the VIX is being stuck in a very low place for a long time, and every spike in the VIX gets sold faster, and a lot of it is attributed to the fact that you have inverse ETFs like XIV and SVXY that weren't available a few years ago. So I think what's going on is too many people are short VIX without really understanding what happens to these ETFs when the VIX actually does spike, because most people have been in XIV or SVXY under 2 years, and they haven't seen a real VIX spike. So now the VIX is starting from a very low place, from 11 or 10. So going over, 20 or 30 years, the long-term averages of the VIX is 20. That's 100% away from here. That's just to get to the average. Average long-term VIX is 20, not 15, not 14, but 20. So think about that. If we get to 20, a lot of people that are in SVXY and XIV are going to be down 50 or 60% in a matter of just a few trading days. And what they're going to do, they're going to be liquidating their positions. And when those funds liquidate, that means that because they're short VIX funds, then the fund has to buy VIX futures in order to cover these positions. So that's going to contribute to a situation where all these funds are going to be buying VIX when the VIX is already spiking. So that's why when you move above 15, 16, 18 level, those people in those funds are going to be down 30, 40%, and then they're going to be wiped out of their positions, especially if they're on margin. And I think that trade is extremely powerful because a lot of people that are not anticipating this are going to be squeezed out of those positions.
Yeah, for sure. Definitely. But yeah, I think this is the safest trade, because even if the market goes up, then the VIX doesn't really go anywhere. So you can potentially, the VIX just stays the same, where if the Dow was making new highs, then you won't see the VIX as low as 10 or $9. So I think it's the best trade to just hold, and then if it does, the volume does come and the market does have this big correction, then you're due a super payout if the VIX hits $30.
I think the VIX is bottom for the year. I don't think you're going to see 9 again for this year.
Wow. Well, yeah, that sounds good. I hope you're right, because that would pay off tremendously.
Yeah, I'm in the same boat as you. I have the same trades going on.
But yeah, it's interesting. We'll see what happens. I think this week's coming up is going to be very interesting. I think it's going to be a big fight between bulls and bears, and we're going to see. If we make new lows, then I think that's going to confirm it.
I agree. Although you have to take into account that this week is the 4th of July weekend, and a lot of traders, including myself, are on vacation. I'm speaking to you from a little tropical paradise here. So there may be a little bit less trading than normal. So in the worst case, we may chop around for another week. I think the volume is going to come back probably towards the end of the week.
So what do you think for Thursday, Friday?
Probably, yeah. I would expect the market not to do too much. Monday's a short trading day. Tuesday, the markets close altogether. So a lot of people are going to come back. A lot of people are taking advantage of it, going for a week vacation and things like that. At least 3 traders that I know are not going to be trading this week. So, it's going to come soon, and potentially not this week, but I think within the next 2 or 3 weeks for sure.
Yeah.
So I wanted to go over this chart. This is kind of interesting. So you're talking about shorting the IG index and things of that sort. I want to show you. Have you ever heard of the RightX fund family?
No.
It's a mutual fund company, and they have a lot of products like short ETFs or short mutual funds and things like that sort. So this is a very good proxy for the short interest in the market. Basically, how many people are short versus how many people are long, because this measures the dollar volume in the actual stock market of how many people are short and how many people are long. So when this thing trends down, that means less people are short. When this thing spikes up, it means more people are short. And look where we are now. We're very close to the lowest levels of short interest that exists in the market. It's actually kind of interesting. You can see how in 2013 and 14, this is a 5-year chart, the market's trending up and up and up, and this short interest is moving lower and lower and lower as essentially bears have given up. And what's happening here is really interesting. The market is just moving flat and kind of topping out in 2015, and the short interest has gone all the way to the bottom level that it can get. And look how interesting this is, where we see a little bit of a divergence, meaning a little bit more short interest into the flat market. This is the smart money. The smart bears are starting to accumulate shorts. You see that here? And then we got that 20% drop in 2015. And when we got that drop, guess what? Everybody's going short.
Yep.
When the market's already down.
Yep.
Right? And then what does the market do? Shoots back up. And then it shoots back up, those short positions cover. And then in 2016, we had that second dip for this double bottom of 15 and 16. And the short interest gets even higher. And then for the entire last 2 years, short interest has just dropped all the way to the low range. So I think we're having a similar thing that we had in 2015, where the market is in a topping pattern over the last few months, kind of grinding up, not really going up too much, and a little bit more shorts, but not that much. I think these are the smart bears, very similar to 2015. When we do get a bigger drop in the next few months, and we do see short interest jumping up like we did here, that'll probably be the time to buy it, because there's a lot of fuel of all these shorts that have to buy back their position. But right now, we don't have a lot of shorts. I mean, how far can this possibly go? It doesn't really go below this level, because that's only 1.7% of the assets.
Yeah.
So in the real stock market, as far as dollar volume goes, there are almost no shorts currently at the moment. And we see the slight bullish divergence here in this short interest. So I think this is another big tell of the topping in the market here.
And do you think we're going to have, because that seems like the same kind of correction we had in 2015, can you see something similar like that happen again this year?
Yeah, very, very similar. So to me, a good sign to buy it would be this big spike in the VIX, this big jump in short interest. Like this jump in short interest was a huge indication to buy the market, right? Because everybody's short.
Yeah.
So right now we have the opposite. We really have the opposite here. We're at the lower range of the VIX. I think the market's definitely topping. So people have to realize that topping also takes a long time. It can be very frustrating. Go back here to the S&P. I think we're seeing this wedge pattern unfolding, and it's been lasting for a long time. But you can see, just like the VIX is running out of room to go, we're also running out of room to go in the S&P. So maybe it will chop around in this area a little bit longer. But essentially, once the low of Thursday gets taken out here, I think that it's going to be time for the unfolding of this event. And it doesn't mean the market's going to crash right away. I can also see, for more conservative traders out there, it will probably do something like this, because you do have a lot of initial support at this level. So maybe it will get bought initially and have some kind of a rebound rally to test that underside, and then probably that will be the move. So I think this place here, assuming it does it this way, would be the ideal short entry point, because you usually have this quick rebound rally and then it fails in the big move down. But it doesn't have to do this. It can just go straight away. So I would probably be going into the VIX trade, as you said, right now, and I'll be putting in a lot of other types of trades. But if we do go down, it's probably going to look something similar to this.
Mm-hmm.
A little bit of a check on the banks. I think that the banks are looking really interesting at the moment too, because they're trying to break out and then had a little bit of a failure in the last couple of days, and this could be a double top to me. I think this could be a really low risk short. So as well as the VIX calls or things of that sort, I think your stop can be only above this high, so you're taking very, very limited risk. And if this is a double bottom, a double top, then assuming that this is the top and this is the range, so we extrapolate the range to the downside, right? So we can be looking at a gain of approximately $4, right? Mm-hmm. And we're risking how much? Less than 50 cents. Right. I like that trade a lot. And there's also an open gap here. Most gaps get filled at some point, right? Mm-hmm. So it's interesting how the open gap fits the measuring objective from that potential double top, right?
Yeah, that is interesting.
So I like this trade a lot because I think this is really low risk and really high reward. Your risk-reward ratio here is 8 to 1 or 9 to 1. So I like risking $1 for the potential of making 8.
Yeah, of course that makes sense.
So yeah, that's my 2 cents on the market at the moment. So it's going to be a short week. There's probably not going to be too much going on, but I see a lot of evidence of long-term topping in the market. We talked about the breadth last video. We're talking about the short interest kind of picking up a little bit, but still relatively very low. The VIX, I think, is very stretched. So the market is too complacent. The dip buyers have had their way for 2 years. Every dip has been an opportunity to make money. Every dip has been easy to make money, and nothing in the market's really that easy for that long. So it's probably time for them to get punished.
Yeah. It'll be interesting. I think the next few weeks of the market is going to be extremely interesting, and it's going to dictate what direction we're going to be going in.
Yeah. Yeah, absolutely. So so we take it at that.
Okay, guys, don't forget to sign up to our YouTube channel. We're going to be providing you with videos on a weekly basis, plus we're going to provide more other videos with useful content, so make sure you subscribe. Also get in touch with us at contact@ScofieldTrading.com is our website, and also our phone number.
Sure. So remember, we're coming really soon. We're hard at work here. So we're coming up with, I think it would be a series of options courses, but we come up with the first option course. It's going to teach all the basics of option trading. You're going to learn the secrets of all the 8-figure and even 9-figure hedge fund option strategies, calendar spreads, butterflies, and this sort. You're going to learn how to make money in all market conditions and limit your trading risk. So we've talked about this VIX call idea. There are a lot of ways in which you can make money. You can make money when the market doesn't do anything, trends sideways. You sell options, you buy options. So we're going to teach you how to do all this stuff, and you'll be able to take some tropical vacations while you're making money.
Sounds perfect. Okay, guys, so we'll see you next week for the next update.